Perfect. So again, welcome to DeFi Toronto, our August meetup on August 31st, 2023. Just before we get things started, just wanted to say the topics discussed here are for informational purposes only, not for financial advice. And we have a pretty good lineup for you guys today. So just wanted to walk you through the agenda, which I'll do on the next slide. But our speakers for today are Bryan Zheng, Casper Back, Akiva, and Ashwin. So we'll introduce them a little bit more in the coming slides. But first, I wanted you to meet our team, and I'll kick it off with Aleem.
Hey everyone, how's it going? Aleem here. I'm one of the original co-founders at DeFi Toronto, and I work with a DeFi project called Delve, and we're building kind of DeFi protocols and infrastructure. And if you want to learn more about it, delve, DELV.tech. Thanks.
Awesome, thanks, Aleem. I'll talk about Imran next, who's unfortunately not able to make the meetup today, but Imran is one of the co-founders of DeFi Toronto, and he's also co-founder of LangChain.ai, which is the intersection of AI and Web3 wallets. And with that, I'll pass it on to Victor. Victor, are you there?
Actually, I think Victor is still joining in, so we can skip ahead.
Perfect. So our next person up is Mark, who's also unable to join us today. He is the co-founder of DeFi Toronto as well, one of the board members and co-founder of French Tech Toronto, which brings French Francophone and Francophile entrepreneurs, business leaders, and innovators from the tech to the GTA. And he's also chair for the IEEE blockchain chapter for Toronto. And then with that, I'm up next. So I'm Sophia. I'm global events lead for Chain Safe Systems, which is a R&D protocol. We build on different blockchains like Ethereum, Filecoin. If you want to know more about Chain Safe, you can hit me up later, and then I'll pass it on to Johnson.
Thank you, Sophia. Sorry, it seems like my video is not working. But hi, everyone. Welcome to the event. My name is Johnson. I'm a marketing specialist at Virgo CX. I joined the team this year, and it has been like a fantastic growth since then. And I'm happy that all of you are here with us during this bear market. And that's it. That's my introduction. Happy to talk to any of you if you'd like to connect later.
Great.
Over to you, Sakir.
Awesome. Is Victor back on the call? Okay, well, we'll just tell you a little bit about Victor. He's also one of the co-founders of DeFi Toronto. If you want to get to know him a little bit more, you can hit him up after the space as well. His Twitter is cryptoecon_li. And with that, I'll go with the agenda with what we're going to be talking about today. We have quite a few speakers, so we're going to move this along. First up is the DeFi news recap. After that, we're going to go to Bryan, who's going to talk to you about a guide in the dark forest. Then we have Casper Back, who's going to talk about Web3 insurance and DeFi assets protection. After that, we have a 5-minute break and community announcements. And then we're going to go to some of the inventors of PairWyse, Ashwin, and Akiva to talk to you a little bit about PairWyse. All right. If you are just joining us, or if you have been an active member of our community, we have about over 2,500 members. But we did just start a Telegram group for DeFi Toronto. So this is a QR code. We will share it in the meetup. We will share it on our Twitter, any other socials. So please follow us and join the Telegram group for more updates. Perfect. And with that, I'll give it to Aleem, who's going to talk a little bit about the DeFi news recap.
Okay, thanks, Sophia. So yeah, Johnson and I are going to cover the DeFi news recap for this month. And we're going to start with a protocol that we've been following pretty closely. So Spark protocol is kind of part of the MakerDAO ecosystem. It's one of MakerDAO's first kind of direct forays into the DeFi space outside of dealing with just kind of the core contracts. It is basically a protocol for lending and for borrowing DAI. So you can borrow DAI, as you can kind of see on the right hand side here, directly from essentially Maker, because Maker is providing this debt ceiling to Spark to be able to lend out DAI. So you can borrow at 5%. And oh, Sophia, I think you're showing, yeah. You can borrow at 5%, and then you can, you know, for people that want to deposit and actually earn a yield on their DAI, they can deposit and earn 5%. Interestingly, just I think it was just earlier this month, there was a pretty large discrepancy between. Oh, I think there's some background noise. Maybe if I could just go on. I think. Yeah, thank you. Interestingly, there was a pretty large arbitrage opportunity. So you were able to deposit DAI into the DAI savings rate, the DSR. And the DSR is one of the ways that the DAI stablecoin is kind of keeps its peg. Think of it almost like a little bit of a backstop. And that was offering 8%. So not too long ago, you were able to kind of like you know, borrow DAI at 5%, deposit at 8%, and you were able to earn a pretty healthy spread. That's since kind of corrected. But the interesting thing about Spark is that it's probably one of the fastest growing DeFi protocols we've ever seen. Very quickly, it's grown to close to $500 million in total value locked. And you can kind of see here on the utilization with the two charts there on the left-hand side. So, you know, the debt ceiling is now close to 700 million. And the amount borrowed is just over 220 million. And so there's about 460 million that's currently available. So 5% is a pretty healthy amount for DeFi, especially considering Spark's relationship with MakerDAO and it kind of being a staple now in the DeFi space with a pretty long-standing reputation because, again, MakerDAO has been around for a long time. So yeah, this is definitely a protocol to follow, and I think Johnson's going to get into a couple of other protocols as well. But last thing I'll mention is the month-over-month TVL increase is, you know, it's increasing at breakneck speed, 677% month-over-month. It's currently sitting in the 16th spot on the DeFi Llama list of top DeFi protocols by TVL, specifically for the Ethereum ecosystem. And I imagine that will tick up pretty quickly. Yeah, so just keep an eye out for those guys. Next slide, please. Okay, so this has been some pretty big news that I imagine many people have been following. And you know, this is also one of the reasons that I think at least that we've seen a pretty big uptick in you know, Bitcoin's prices and many of the other cryptos that have followed suit over the last couple of weeks. You know, I think we saw close to a 10% increase on the day that this announcement came out. Grayscale has been vying for approval of the SEC to review their ETF application. And, you know, the SEC has been, you know, acting fairly, maybe discriminately. I don't know. I probably shouldn't say that, but, you know, they haven't been giving a fair chance to many of the applicants to have their ETF applications reviewed. And, you know, so there was an appeals court case that happened where Grayscale was, you know, basically saying that they weren't being treated the same as the other applicants. And the results was from the court ruling was actually in favor of Grayscale. So the SEC is going to be reviewing their application now. And Grayscale, so basically the ruling was Grayscale has demonstrated its proposed Bitcoin ETP is materially similar across relevant regulatory factors to the approved Bitcoin futures ETPs. First, the underlying assets, Bitcoin and Bitcoin futures, are closely correlated. And second, the surveillance sharing agreements with the CME are identical and should have the same likelihood of detecting fraudulent or manipulative conduct in the market for Bitcoin and Bitcoin futures. So this is pretty big. Yeah, so it's basically, it's proposed ETF will probably have a very fair chance of being reviewed and potentially being accepted. And ultimately what this means is that it kind of clears the path for a spot Bitcoin ETF. And it increases the likelihood that the SEC might ultimately approve all the current applications together. So that if that does happen, and a Bitcoin ETF and probably other ETF products, Grayscale's product is currently a trust, GBTC. But many other products, if they do come online, we're going to start to see a huge uptick in the amount of retail indirect investment back into crypto. And I think it's very possible that could be the spark for the next bull market. So keep a close eye on that. And next slide, please. Okay, so yeah, so like Uniswap also recently had some legal troubles, and there was a case against Uniswap where the courts were alleging that they were responsible for some scams that had happened, and as a result they should be liable. There was kind of a victory, which was not just for Uniswap, but kind of for DeFi, because in the past, it was quite clear that the courts and regulatory authorities maybe didn't have the best understanding of DeFi and how it worked. This case proved that is kind of changing. So Judge Catherine Fila, who presided over the Uniswap case, basically concluded that developers of the platform could not be held responsible for how the technology was used. She basically stated that Bitcoin and Ethereum are commodities and remain hesitant to extend securities laws to certain areas of the crypto industry, and suggesting that that should be kind of a matter for Congress to decide. But ultimately, they essentially said that the platform is effectively decentralized. There's no way for anyone to effectively enforce any agreement between a buyer and a seller. Everything is executed automatically by code, and the protocol is effectively decentralized. So the software platform itself, can't really be held liable, right? It's just executing code. And so that I think that's ultimately a big win again for Uniswap and for DeFi. And hopefully we'll start to see more favorable and knowledgeable conclusions to many of these legal cases that are still ongoing. With that, I'll pass it off to Johnson to continue.
Thank you, Alim. Next slide, please. All right. So with respect to layer twos, if you look on the charts on the left, the top left one is taken up from L2 beat. And what we've been seeing especially since the start of the year, is that I think a little before the start of the year, October 2022 to be precise, layer 2 transactions, just by numbers, are much more than, have overtaken and are currently much more than Ethereum transactions by a scaling factor of 5x. And this is just the bear market. Like right now we're in the bear market. Like I'm even doubting if we are in the bear market by looking at all this layer 2 transactions that are happening. And the chart on the bottom left shows the breakdown per chain, with ZK Sync leading the with most number of transactions. But layer 2s, be careful, like they're not fully decentralized and fully secure. These are new chains. However, they are very much in line with Ethereum's roll-up centric roadmap to scale Ethereum. And what we've been seeing is that for many of these layer 2 chains, they are becoming more general purpose and allowing other projects to develop more chains based on their software stack. So if we take OP, for example, or Optimism has its OP stack, a lot of new players have come in, most notably Base by Coinbase, which is now built on the OP stack. But then apart from that, there's Arbitrum, which is coming out with Arbitrum Orbit. There's ZK Sync coming out with ZK Stack, which is anybody could spin up ZK chains. And then even Polygon has recently announced its chain development kit, something like a Cosmos SDK where you could spin up your own chains, and this would be like a ZK chain within the Polygon's ecosystem. So this is a very interesting development that we are seeing. And all around L2s are really good with respect to scaling Ethereum, and we'll need to see how it plays out in the bull market. Next slide, please. Now, with respect to apps on L2s, this is an app that caught a lot of hype over the last month. It's called FriendTech, and what it basically does is that it allows people to buy shares. Now they renamed it to keys of like shares of other people, so that based on the popularity, more and more people buy more and more shares, and the share value goes up according to a bonding curve, which is like the graph on the lower bottom. It's not based on like any liquidity or dexes or none of that. It's just based on the bonding curve. The more the number of holders, the more the number of shares or keys bought, the higher the price goes up, and vice versa. Now, looking in terms of the protocol fees, like this, for every transaction, there's 10% of fees taken, 5% goes to the protocol, 5% goes to the person itself, like whose keys are being bought and traded. This app alone accumulated $4 million worth of fees on Base. And the demand for it is absolutely like crazy. There's a lot of speculative activity going on right now. Transactions are down, a lot of share values are down. This could be like a pump and dump, but what this really brings to the layer 2 landscape is innovation in terms of a brand new software stack where people could sign up with just authenticating their Twitter, have a non-custodial wallet assigned to them immediately, no need to store seed phrases or anything like that. And then, that kind of a new software stack, a new infrastructure that more apps can use to make user adoption much more simpler for the next billion people. And we saw that in terms of like it's not just crypto people starting to use this. People from other industries have also come into it, notably basketball players, YouTube influencers, OnlyFans stars, and the improved UX is a testament to that. So that's what we should really take away from this app. Next slide, please. Trading bots. Telegram trading bots, most notably Unibot, has gotten a lot of strong user user retention, which is an even more important metric. And now what Telegram trading bots do is that they remove all the complicated things that you need to do in terms of like managing your wallets, going to the DEXs, connecting, trading, making sure the slippage, MEV protection, and all of that stuff, all within a single chat. And then they give you options. You just select whatever you need to do, and then it's protected, it's fast, it's quicker than what you currently do. And it has also, this also like signifies improved UX. There are risks to this, like for example, the wallets are not entirely non-custodial. They are hosted by the Unibot cloud. But the improved UX, the key way to and we are seeing like in terms of like the metrics, the market the number of users who are coming back to use this, even despite the pump and dumps of prices, it's still a good thing to see that there's people working on UX side. Safi, next slide. Thank you. Now this is just checking in on the wallet trading operation that we had brought to the community's notice a couple of months ago. This is still going on. It's not stopped. Basically, just for context, a large number of wallets were getting especially these wallets with like huge amounts of crypto. They were getting all drained and being sent to like multiple wallets taken away by hackers. And there's and people haven't found out yet like where this money is going or what the cause of the vulnerability is. However, recent updates show, especially from the protocol security at MetaMask, they show that the suspect right now is LastPass. Specifically, there was a LastPass breach in 2022. The details are not fully out yet, and apparently LastPass is not cooperating with them to reveal the full details of the scope of what was exactly stolen. So if anybody has like passwords, or seed phrases stored in LastPass accounts, please do be careful. Especially if you have huge amounts, it's always better to like store it in a cold wallet. Next slide, please. And for our latest Gitcoin grant update, we've raised 138 Canadian dollars from 63 donors. Now, this is fantastic news, guys. Like, thank you so much for supporting the work we do at DeFi Toronto. There were two notable things that happened this Gitcoin grant round compared to the earlier one. Number one, this one was conducted on a layer 2 chain on Optimism. What that means is that earlier when the Gitcoin grant was conducted on the Ethereum chain, gas fees was something like $10 or $20 back in like May when prices were spiking. But then right now, because this was conducted on the Optimism chain, every transaction was within a few cents, like less than 10 cents. So because of that, we received many donations that are in like single-digit dollars, but for which like fees paid were like sub-cent transactions. So that is one. And number two, there has been like speculation on Optimism's airdrop, because last time when Optimism did an airdrop, they rewarded each address that donated to Gitcoin grants some 555 OP tokens. So there are people speculating that maybe Optimism might do it again. It might not, but still, I mean, so for some, it's worth the risk. But overall, thank you so much for your support. This is like very encouraging to see 63 contributors, $101 in funding. And this is very, very supportive for public goods. And this will allow us to help keep DeFi Toronto like free and promote free crypto education. Next slide, please. Now on to some community announcements, some conference announcements. We preside. Next slide, please. Now, the first one is we have this conference that's happening, a forum that's happening in Montreal. It's focused on cybersecurity and digital trust. And if anybody is interested in speaking opportunities, booth sponsorships, or even just a free ticket, or you happen to be in Montreal, it's available for DeFi Toronto members. Contact mark.lejeune@forum-incyber.com. There's one more slide, but I don't think it's here. Safi, could you refresh the page? Just check if there's one more slide. There's a slide on permissionless. So if anybody is in Austin, Texas, looking to go to permissionless on September 11th to 13th, and you're looking for a ticket, the tickets cost something like upwards of like $1,000, but then we were able to secure a discount, a 30% discount on tickets. You may use Toronto 30 as the promo code to get the discount and book your ticket for 30% off. That's it for conference announcements. Thank you very much.
Awesome. Thank you so much, guys, both Aleem and Johnson, for doing the DeFi news recap and then also community announcements. We're really excited about the Gitcoin grants, just like Johnson was saying. You know, that like 60+ contributors is amazing. We want to be very transparent with how we use the funds as well. So this will go to like marketing efforts and also user growth within the community. So stay tuned for more updates. And thank you for everyone who's contributed to us as well. So with that, we're actually gonna start with our first speaker. So our first speaker is Bryan. Bryan Zheng is COO of EigenPhi and the founder of Startup4Chinese Community. With over 2 decades of experience in the IT industry, Bryan is now focusing on the DeFi industry. He is passionate about improving team productivity and cohesion, and enjoys facilitating communication and understanding between different cultures and communities. So we're going to give it up for Bryan. Thanks for joining us. I'm going to make you a host right now, so you're able to share your screen.
Okay, thank you guys for giving me this opportunity. So yeah, let me share my screen first. All right, I'm gonna be getting to the topic. So my sharing today is about MEV 101. So essentially, I have a subtitle called "How to Get Kickbacks from MEV Instead of Losing Money." So so here's the outline of my sharing. So first, I'm gonna talk about what is MEV. Then I'm gonna share about like what's good MEV, bad MEV, and even ugly MEV. And next, I will tell you guys like how to get your kickback while being part of some kind of MEV. And in the end, I'm gonna talk about MEV supply chain. Okay. So what is MEV? So first, I want to start from the revenue that has been generated from MEV. So in 2023, as of August 17th, so on Ethereum and the BSC, so we already got like 1.37 billion revenues from arbitrage and 252 million from sandwiches. So this is a distribution among this year. So you can see usually the market's volatilities often create all kinds of opportunities for MEVs, including arbitrage and sandwiches. And okay, so essentially, what is an MEV? So usually, I think some of you guys have the background of traditional finance. You guys might heard of high frequency trading. So essentially, MEV is kind of like the high frequency trading of crypto, and the MEV searchers, so they can observing all these transactions that hasn't been put into on-chain yet. They're gonna observe all the mempools, whether it's private or public. So they can do some kind of after they notify the signals, they can reorder these transactions. So it involves a different kind of MEVs like front runs, back runs, and GITs. So MEV is not necessarily bad. There are some good MEVs and there are some bad MEVs. And we can look at some good MEVs. So first, the good MEV, because it's like these MEVs can increase the liquidity in the decentralized market. So essentially, it's like increase the efficiency of price discovery in the whole market. And other than that, it can offer opportunities for innovative like profit modules for different protocols. And I think we can look at one MEV backrun to show like how exactly this MEV actually works. Just bear with me. So can you guys see my screen? Okay. So this is the arbitrage. This is arbitrage identified by EigenPhi. So you can see that there is a signal transaction. So the signal transaction means that this is a transaction that has created a price discrepancy in certain trading venues, whether it's a liquidity pool or it's something else. And this is another like MEV searcher. He monitored this kind of price discrepancy and he utilized it to create a arbitrage. And so you can see that this arbitrage actually, the cost is only like $6, and eventually the profit is like almost 23K. So it's actually a very good opportunities to make money out of this background opportunities. And the thing is, like, if you want to see more clearly about how this MEV arbitrage opportunities has been created, so you can see all these transactions in this block. And so the arbitrage I showed you is in the position number 3 in this block. Actually, its second transaction is actually the transaction in the position number 2 here. It is a background of a sandwich. And if you dig more into this whole block, you can see that this transaction in the position number 3 actually creating another arbitrage opportunity that has been utilized by the transaction in the position number 5. And the more interesting thing is, like, if you check out all these EOAs has been doing all these sandwiches and these two arbitrages, it's actually the same EOA, and he's been using same MEV bot, all these kind of things. So what I'm saying is that it's like, so sometimes MEVs, whether it's good or bad, so the boundary is not very clear. Let me switch back to the slides. Okay. All right. So let's see what is the bad MEVs. So like I said, bad MEVs involve front running and other unethical behaviors. You're gonna see more unethical behaviors in the ugly MEV here. So the MEV searcher, the sandwich searchers, to get their transactions accepted by the builders, they often like pay like priority fees or bribes to the block builders. So essentially, all these block builders using all these fees to get more advanced infrastructures, to get more searchers to invest into their to use their block building services. So essentially, it's like a flywheel, and trying to get more and more searchers using same kind of stuff. So essentially, the block building is getting more and more centralized. And there is another trend. It's like it's called builder searcher integration. So usually, so if you check out the website called mevboost.pics, you can see that the top 5 builders, actually 2 out of the top 5 builders actually integrated with searchers, which means that these builders are actually doing searching themselves. Okay. So yeah, as I mentioned, so sandwich or AKA front running can have many victim transactions. For example, this is a 5-layer sandwich. It has 3 victim transactions. We observe that sometimes I think the biggest sandwich is like a 43-layer sandwich, which means that sandwich actually has a 41 victim transactions, and they all like suffered a sandwich attack. So in the end, all these bad MEVs like harm the network's security and the decentralization, which is a very important feature of blockchain. And next, we can look at some of the ugly MEVs. So what I mean ugly is like they are not just like doing some kind of day-to-day sandwiches. So they can exploit some of the contracts vulnerabilities and made a big profit out of them. And so the first one here is exploit contract vulnerabilities. So this one is actually the searcher actually utilize a vulnerability of the protocol called Abracadabra, and so the pricing in the smart contract did not update like on time, so which created some kind of a price discrepancy, and so the searcher utilizes this opportunity to do a arbitrage. And next we have this bait arbitrage bot, which means that these guys actually create several algo coins, and these algo coins used to bait all these searchers who are doing sandwich attacks or arbitrage attacks. arbitrages, and eventually the searchers actually kind of using some malicious code to attack this post and get their clear out their EOA addresses access. And the other one is like broke consensus. So last year, some 3 out of the top 5 sandwich bots actually got attacked because of because some validators actually use vulnerabilities in the relay, and basically that kind of that incident causes 3 sandwich bots lost about $20 million US, like in just one block. So the other ugly MEV is called manipulate oracles. So basically, it's like this MEV searchers, they can use some kind of assets to manipulate some kind of some protocols oracle price mechanism. Eventually, it create this pricing discrepancies and utilize them to make profit out of it. So how to avoid bad MEVs? I think for like day-to-day traders or your retail traders, the most important thing is like you need to use protection. Like this is the easiest way to avoid being sandwiched or front run. So you can just add some RPCs to your wallet, whether it's MetaMask or something else. And you need to use, when you're trading cryptos, you can just use that RPCs to avoid that your transaction being sent to the public mempool from being sandwiched. And the next important thing is like when you're trading cryptos, so you need to watch out your slippage. There are always slippage settings. I think there are ones I noticed that the slippage settings in MetaMask is like 3%, which is pretty high. So usually you need to set your slippage like as low as possible, even when you think you're gonna miss some kind of opportunities. Because like I said, so I think you may have heard of this very big sandwich bot called Jerry from Subway. So our research find that he's actually been sandwiching those guys who are FOMO, who are trying to trade some kind of very like popular tokens. Eventually got sandwiched by Jerry. And the other thing is like you can use some MEV aware protocols when you do crypto tradings, and I'm gonna talk more about that later. Okay. So now we are getting to the how to earn your kickback part. So like I said, all these MEV aware protocols or projects called MEV blocker and MEV share. So these are all MEV redistribution mechanisms or outflow auction mechanisms. So after the merge and the PBS, so this kind of projects and the mechanism are getting more and more popular. So we can actually show you, I can actually show you like how MEV blockers actually work. Just give me one. Okay, so this is like a MEV blocker transaction, a series of MEV blocker transactions. So the first transaction here, the user actually did a swap. He traded ICE with STG here. Then his transaction got sent to the MEV blocker private mempool. So some searchers actually notified this transaction, and he notified this price discrepancy between a sushi swap pool and another Uniswap V3 pool. So the searcher just backrun the user's transaction. So to get his backrun successfully bundled to the chain, he need to pay the builders 0.016 ETH. You can see here in the step number 5. And so the mechanism of MEV blocker actually decided that if the searcher want to stay in this MEV blocker network, he need to pay the builder, and the builder need to like refund 90% of the builder payment to the searchers. So in the search transaction here, you can see that builder actually paid back 0.014 ETH back to the searcher, back to the trader. So it's 0x4E8. you can see that. So this is a 0x4E8. So this is a MEV blocker transaction. So MEV share is kind of like the same mechanisms. So MEV share is basically have the same kind of mechanisms. So I think at the moment, MEV blocker and MEV share are the two of the most popular MEV distribution projects in the market. So all these retail traders, whether it's in the private mempool or in the public mempool, they are creating order flows on so all these protocols can use these order flows to create more like perfect models, like I mentioned before. So basically, on the order flows, there are two ends of this order flows. The order flow originators, they want to do like more MEV aware design so that you can get more value out of MEV, and maybe like redistribute them back to the users. So eventually, all they can do is like to do more MEV leakage evaluation, and they can also use the all these evaluations to figure out like which OFAs they want to work with, and then they also can like to do some kind of a peak period analysis to figure out like during the market volatility, so they can how much volume they can extract from the MEVs, and essentially they can enforce non-toxic MEV, which means like they can do something to stop sandwiches and other front running and those kind of stuff. So for the OFA providers, so they need like evaluate all these order flows and the MEVs among them to like assure the execution qualities. So it included two aspects. First one is like value capture appraisal, and the other one is like latency correlation analysis. So basically, like if you want to win a trade, whether it's an MEV or not, so there are two things that are most important. First one is the price. The second one is the speed. So so for the OFA providers, to access these values, and the latency is very important for them. And also the other thing is like they also need to like figure out like what's the value capture during the market volatility. Things like they need to figure out like how to prevent like toxic order flows, which means sometimes builders could like the bad builders can like actually work something out to stop the searchers in the OFA mechanisms. So to get the MEV values to themselves, which is like toxic MEV or toxic order flows. Okay. All right. So let's I'm gonna make it faster. So this is the MEV supply chain. So this supply chain is like if you're a user, you can send your trade to wallet. So the wallet can send your trade to the order flow option, and the bidder is like the searcher that's doing the backend. And then all the transactions are going to send to the builders. Eventually, the builder can send all the transactions into a block and send it to validators. Eventually, this is going to get on chain. And we also have this like all the values allocation among the MEV supply chain. I won't go into the details here. So because of the time is pretty limited. And if you want to know more, I can definitely share this with you guys. And okay, so here are all the resources I've been talking about today. And yeah, you can find me at BRYN at EigenPhi.com. You can find us via our Twitter and Substack and our YouTube channel. All right, that's all I'm sharing.
Awesome. Thanks so much, Bryan. I'm going to open it up to if anyone has any questions, you can post them in the chat and I can read them out, or you can just unmute and ask right away.
Just got a quick question for Bryan. Thank you so much for that presentation. Really insightful. I just noticed you were like, actually, where are you getting your data from, like to index the chain? I saw that. I think you were using TokenFlow.
Sophia, you should be the host now.
Yeah, perfect. Thank you. Aline, do you want to ask your question again?
Yeah, Bryan, are you using token flow to kind of index the chain and kind of obtain data on transactions, or how are you obtaining that data?
Sorry, I cannot hear any of you guys. So, can
Okay.
you hear me?
Yeah, we can hear you, Bryan. You know what? I'll just put the question in the chat, and we can kind of move on to the next speaker.
Sure. Does anyone else have any questions for Bryan? Okay, awesome. So we're gonna move on to our next speaker, Casper. Just give me a thumbs up if you're good to go. All right. Just wanted to check if Casper's on the call. Calling Casper if you're on the call.
I don't think I see him in the list. So if
Okay.
the PairWyse guys are
Yeah,
ready,
and I do see PairWyse here. Maybe if you guys are good to go, then we can move on to you first.
Yeah, sure.
Okay. I'm
Video for a sec, just so
awesome.
we're real people here. Yeah, thanks
Okay.
for having us join. Can I share my screen?
Yeah, give me 1 second. I'm gonna give you just the permissions and I'll introduce both of you. 1 sec. Okay, perfect. So before we start, I'm going to introduce both Akiva and Ashwin. So Akiva was a former blockchain consultant at KPMG Canada prior to forming Web3 venture studio Akiva Capital Holdings. And prior to joining KPMG, Akiva successfully led Ethereum Foundation's private ETH transaction with venture capitalist Dennis Bennie, Bennie's firm XDL Capital, where he was chief blockchain officer. Akiva has also served on MakerDAO's open market community for DAI interest rate policy. So Akiva, that's amazing. And Ashwin also was a PhD and a former co-founder of Patnam Labs and former chief data scientist at Patton, one of the largest digital payment and credit platforms in Asia. And this prior to co-inventing PairWyse, Ashwin led the data science innovation group at KPMG and analytics and AI transformation at Scotiabank. Prior to working in e-commerce and AI, Ashwin was a former faculty member at the University of Pittsburgh and holds a PhD in molecular virology. So that is amazing. Very excited to hear about both about PairWyse. And with that, I'll give it back to you guys.
Awesome. Thank you for the introduction. Akiva and I myself have been working on PairWyse along with a group of developers. We've been kind of this is actually the first public presentation outside of sharing it with potential users and groups who are interested in backing this project. Thanks for letting us share this project with you, and would love to get your feedback on what we're trying to do. So maybe Akiva, maybe you can describe just kind of how we got to building PairWyse.
Yeah, we were involved in other DAOs, and we saw that there was a problem with DAOs in general, in that smart contract design patterns and how they're built have some very serious limitations in terms of upgradability, and how upgradability is placed off against immutability. So if you think about what exists today, there's something called the Open Zeppelin upgradability pattern. A lot of DAOs have a waterfall upgrade process where they'll just release V1, V2, V3, and they won't have any upgradability. For example, Liquidity is a DAO which is very immutable, whereas you find some other DAOs which use the Open Zeppelin pattern. And what we wanted to do was create a world where we can have the most of upgradability and the most of immutability. And the way to do that is to create the ability to have backwards compatibility on chain, and to have rights enforcement on chain. And to do that, we created our own programming language, which is compatible with any EVM blockchain. And Ashwin is going to present to you more about that.
Yeah, so basically, if I give a bit of history on, kind of how we got here, we had originally deployed a fixed rate a derivative protocol. It was basically a protocol for fixed rate lending and investment of DAI over Maker protocol. And it was basically a derivative protocol that introduced an interest rate swap between a depositor in a DAI savings rate and a credit facility in MakerDAO. And we went through a process of writing over 2,000 lines of code, and is basically a contract that wraps over two existing facilities. One is a deposit, one is a savings facility, and then mediates a loan and an interest rate swap over the course of a loan. And this is how we ended up building a derivative to introduce fixed rates on the Maker protocol. And going through that exercise, there was a lot of engineering, a lot of due diligence. We went through many audits, and certainly the upgradability was always on our mind in terms of, if we have to go from a version 1, 2, 3, 4, how do we do this seamlessly? And how do we do it in a way that, we can basically keep the trust of the users locked in on the protocol as we make changes, and do it in a way where users aren't affected in terms of their pre-existing rights, the agreements that they've already entered into, and then beyond that, beyond just fixed rates, we were very interested in the generalization of our platform for derivatives of all kinds. So this is everything from options to futures to exotic derivatives to structured products, to being able to offer multiple tranches and keep adding new issues while maintaining credit worthiness. And basically all the things that any TradeFi institute, say in the capital market space, would do, right? Having clearinghouses, having insurance. And we realized that the current paradigm of smart contracts would not allow for that, and would certainly make it very costly to do everything on chain, especially for applications that required scope enforcement. And so we set out to build a new contracting protocol, and we'll go through and kind of demonstrate that to you. We'll probably show you some videos of how the protocol actually works, because it is pretty technical. But more importantly, it's really about the economic problems that a protocol like this solves. And the basic premise is there are certain classes of facilities and instruments and utilities that DAOs cannot provide purely on chain, simply because scope enforcement of smart contracts can't be performed on chain. The current nature of smart contracts is you compile off chain and then you deploy your protocol in immutable form. For applications that require, say, insurance or any kind of issuance of debt, royalties, anything above a token placement, literally like anything on the liability column of a balance sheet, cannot be done very effectively purely on chain by a DAO. And that's why many DAOs, when they try to make deals with institutions for institutional capital, or try to issue something other than a token, say a convertible note, a royalty, a bond, it becomes a very, very complex process. And typically it results in the counterparty requiring the DAO or its whatever trust subsidiary it decides to invoke and engage it in an actual legal contract, which kind of defeats the purpose of a smart contract. And so all these problems, we noticed in our own efforts to bring a fixed rate protocol, and it was always on our mind how to generalize it. And so PairWyse is really about that generalization and how to do it, how DAOs can overcome this problem without sacrificing decentralization. So as we've been kind of prospecting PairWyse to a number of different users, both institutions, other DAOs, we work very closely with a trading firm in Australia called ZeroCap, who are interested in learning more about PairWyse And just to give you a little bit more about them, they are basically a trading desk and a digital asset management firm. They are regulated in Australia, and they provide a variety of services to their clients related to the management of digital assets, including options trading, as well as very sophisticated products such as delta hedging on options for volatile tokens. And so the interest in PairWyse is really, how can we take, say, an institution like ZeroCap and a line of business such as delta hedging and actually protocolize it on chain in the form of structured offerings. And this isn't necessarily unique to ZeroCap. Any institution that's looking to build a book of business, to build funds and trading facilities, especially for institutional capital, is basically comes across this same problem of how do you actually build scalable blockchain applications, whether they're overnight, and actually how to get deposit, get to basically comes down to how actually as its own credit work and offer it, and and so we went through, kind of educating them on PairWyse. We went into such depth that PairWyse actually decided to write a research report ZeroCap decided to write a research report on PairWyse, and basically take their learnings, and we collaboratively tried to kind of encapsulate why a technology like PairWyse can solve fundamental limits of smart contracts. So we don't have any slides, but we're going to go through some of the visuals and maybe show you some of the video demos and give you a feel of what is PairWyse, how does it work, and what exactly is this fundamental limit that PairWyse is solving, and why an on-chain smart contract compiler is the answer for it. So when we look at just the typical smart contract development and deployment that any company or DAO has to do in the legacy world of smart contracts, there's a lot of work that goes into developing the smart contract that happens off chain, and that's just the nature of how Solidity is developed and compiled. And if you're an enterprise, you go through a very thorough process of business analysis, technical development, validation, financial validation, business validation, and then until all these checks and balances are passed, then a DAO or an institution can be satisfied that they can actually deploy that protocol. Of course, in doing it this way, as you try to get to as you start to build a basic, say, peer-to-peer protocol, the process is relatively straightforward. But when you go from peer-to-peer to now start to offer structured products, this is then where the costs start to compound, the liabilities start to need to be managed, and they start to grow in complexity. And when you're dealing with a complex protocol and upgrading it, you're under legacy, the current smart contracting paradigm, any deployment is subject to operationalization risks as well as migration risks, whether it's moving from version 1 to version 2, or in terms of how, say, a Zeppelin type upgradability is made compatible in a way that rights, pre-existing rights, are protected. And so this is basically the context that we started looking at and started dissecting. Okay, number one, how can we, when we talk about smart contract scope enforcement, we're basically talking about this whole process of authoring and determining what goes into a smart contract, whether it's a first deployment or whether it's an upgrade. And because all of this happens off chain, applications that actually require scope enforcement, like say insurance, or if a DAO is offering like a hedge protection by leveraging its creditworthiness, it needs on-chain controls to make sure that, say, the credit buffer that a DAO is trying to provide as part of a product doesn't negate in value, meaning that no new scope is introduced on-chain that would potentially affect the creditworthiness of a DAO. And this type of control, you see it in banks and institutions in traditional finance, but you don't see it in the smart contract world, mainly because it doesn't exist under the current smart contract paradigm. All scope enforcement happens off-chain. So what that ends up doing is it leads to a segregated governance problem. And we recognize this, that it was really about, this problem really at its root has the blockchain trilemma, which is any blockchain or any transaction network has to choose, make kind of a rock, paper, scissors type trade-off between decentralization, security, and scalability. If we had to ask it, there's at least, if you look at, DeFi in the last 5-6 years, it's never really crossed past the $100 billion market cap. And that's comparing it relative to traditional finance, where 5 trillion in assets are transacted almost daily under a range of risk hedging and facilities like clearinghouses, as well as third-party insurance. And because of this is almost like blockchain leaving money on the table by not solving this problem. And what it does is DAOs are then forced to become centralized, or at least part of the governance or governance needs to come under legal contracts, under corporate structures. And which at that point, the DAO loses its primary economic advantage, which is decentralization, which gives it fault tolerance, pure autonomy, and the ability to disintermediate using smart contracts rather than using traditional labor and corporate structures and whatnot.
Just to make it practical for a second, think about how it could help DeFi today. I mean, think about some of the biggest protocols. They can only raise capital by issuing a governance token, and for the most part, I mean, they can't issue a royalty. Think about in outside of crypto, a lot of startups grow by issuing royalties to RBF funders, and they can grow with non-dilutive capital that way. But in DeFi today, no protocol is able to grow with non-dilutive capital in the way that other startups can, because of the limitations of the smart contract design pattern. One of our first goals with the protocol is to enable royalties for DAOs, to enable them to grow much, much faster with leverage and grow that way. So that's one of our first practical goals, to make this practical in DeFi today.
Yeah, so you can see, in this infographic exactly what Akiva covered. This is basically the general scenario that we've noticed, and we've confirmed it with many potential client users of PairWyse. So, what that comes down to is, how do you actually overcome this limit? And so if the root cause and the root issue of this is that governance of smart contracts occurs off-chain, meaning scope enforcement is forced off-chain, then really it's about going back to this original diagram, looking at this dashed line, vertical line here, which is the demarcation between on-chain and off-chain, and moving that goalpost all the way to the source of the contract. And this is a paradigm shift in a number of ways, not just because the solution is bringing smart contract publication and making it a purely on-chain process. By moving this goalpost over here, the smart contract is brought closer to the intended legal contract between the parties that they're attempting to create. And so, the way PairWyse works is much different than the legacy way of contracting. So we'll go through kind of show you what's under the hood, and then kind of work our way up to what it looks like in terms of an architecture, and then how it actually performs this tokenization of agreements and converting them into executables, and doing that completely on chain. And so if you think about any kind of clause or agreement in a financial contract, what we did in kind of building the system, what we did was we first of all created an on-chain smart contract compiler that can read not Solidity code, but a much more simplified financial domain-specific language that we created, that we're calling PairWyse. If you look at, say, an intended agreement, such as a GP must deposit, say 2% of funding before a placement date, you can see that there's a condition, there's a signatory, or a person who's obligated to do something, or a group, and then there's an asset, and then there's an amount, and certain conditions. Fund would typically want to do, which is basically debits and credits on a balance sheet and being able to trade externally. Try to aim for the opposite, where the instrument can be created on chain, and not just the instrument, but trading itself can potentially be done purely through smart contracts. And this then helps basically any fund implement complex trading strategies and do so on chain. But the way instructions work in PairWyse is, rather than building a proposal from Solidity and coding it from scratch, you would basically deploy a blank agreement on chain, and the instructions for the smart contract are directly transmitted from the Web3 wallet directly to the smart contract for process and inclusion as data structures, as state variables, and function signatures. All that is done on chain, and this is after the smart contract has been deployed. And in doing so, because the compiler is on chain, the compilation of a smart contract can now be subject to other smart contracts that basically regulate and filter what can be allowed and not allowed to be deployed on chain based on the context of the DAO's governance. And so when an instruction is sent by Web3 wallet to a smart contract, it's processed by the on-chain smart contract compiler. Part of that processing is a check for scope validation. Is the scope allowed? Has there any new restrictions been placed on the scope based on the code that it's reading? And this is important because this is really about giving the smart contract the ability to read the entire code, not just of itself, but of another smart contract, to know not just what the function calls are, but exactly, is it working in the intended way and in an allowable way that's compatible with an agreement. And this is important when you consider things like when you're issuing, say, any kind of convertible note against a token. In the traditional finance world, you typically, issuance against shares is typically governed by a shareholder agreement. So you have a case of one agreement being able to filter another agreement. Now, typically that filtration process is done by lawyers and corporate agents to make sure that any new contract is in agreement with the old contract. Otherwise, you're going to have a dispute with your shareholders. And so to avoid that dispute, a lot of due diligence is done to make sure that contracts are compatible with each other. Well, that's basically the same function as all this validation that happens under the hood with PairWyse smart contracts, is to make sure that whatever upgrade is being proposed and potentially enacted on is actually allowed by the DAO. And so a typical example would be that if it's a governance contract, you only want governance upgrades, not asset management upgrades. And if it's a treasury contract, then you basically just want coding functions that deal with the movement of assets and the management of assets, not necessarily voting and whatnot. So this is where you can then build networks of smart contracts that are specialized by function, that you can have, say, a master-worker relationship between contracts, and then one smart contract can read another smart contract to know that they're compatible with each other. And if all that validation is correct, then it can then be presented to actual token holders or any kind of sub-DAO built from a DAO to basically vote on the consensus of that proposal, and then live insert it right into the protocol, right into the smart contract. So there's no downtime. It's basically the Web3 version of CI/CD, continuous integration, continuous development. And so that's kind of, at a very high level, that's how it works under the hood. And, if there are any questions on the technicalities, happy to go into that. But what it means in terms of an architecture, it's what this system does is basically creates a two-layer architecture on existing smart contracts on Ethereum, as well as it can be generalized to non-Ethereum blockchains that support smart contracts. And the analogy is, whenever you create a new company, you typically register a corporation and you state its location. At the time of registration, you will sometimes specify that this is the charter of the corporation. And then once that's defined and registered, you will then basically, as a board or as a governing body of that corporation, will start to create bylaws, right? So employee bylaws, corporate bylaws, and these would be entered as part of the book of record. And part of the book of record will also include bylaws to create a balance sheet and to create basically the allowable transactions that the corporation can engage in. And so the parallel to this in the Web3 under PairWyse is that once you deploy a smart contract, that's like deploying a corporation with a fixed address. So entity address is fixed and it can be fixed for life. So if you need to upgrade the protocol, you don't need to go from version 1 to version 2 to version 3. You can do it term by term, and you can optimize it in a very granular way, in a way that there is no, you minimize the risk of pre-existing rights being erased, compatibility with the previous protocol in terms of what you promised your users and what they expect. And it's basically affected by having a two-layer programming system within the smart contract. And the first layer is the solidity code. So when an agreement is deployed, basically it's in PairWyse, with what we have with PairWyse is basically an inventory of solidity contracts that basically provide the equivalent of a corporate charter, contracts that basically establish how voting is supposed to happen. And this is almost like creating a constitution for an organization. And this, once it's deployed, it's hard fixed. So it's almost like a country having a constitution, and no matter how much the laws change, the constitution remains the same. It's basically works the same under PairWyse. But then what we introduce with the on-chain compiler is the ability to specify smart contract terms and conditions as bylaws on a metaprogramming layer that exists within the smart contract. And because there is basically a virtual smart contract inside a smart contract, this is then how we can achieve the upgradability pattern that allows upgrades, but also does it only under pre-existing scope enforcement and rights protection. And so this is then how we can move the entire governance process of a DAO fully on-chain, because a DAO can basically write its entire protocol in the form of bylaws rather than having to write it in Solidity code. Those bylaws are much more human readable. So the users have much more of a capacity to interpret what they're getting into. As well, because this system is fully on-chain, authorship is fully peer-to-peer. Multiple authors who are entrusted by the DAO can contribute proposals to the same smart contract. Multiple authors can write the terms and conditions of the same smart contract. And then what that ends up doing, it actually frees up the DAO a little bit, because in the current paradigm, the DAO is the primary and the sole authority to write, only authority able to PairWyse. As multiple users can contribute to the same smart contract. This is where the smart contract can be written by two different organizations. And so there could be, say, a primary organization like a DAO that owns a smart contract, but then is able to extend another contract authorship to a second DAO to basically negotiate terms and conditions. So it's no longer a case of, you go to, a discourse channel, propose something, and then, provide a GitHub pull request, and then propose that this be included in the protocol. There's no GitHub here. The code is stored right in the smart contract in readable form, and anyone can retrieve it and know what the smart contract at the bylaw level is, what the terms and conditions are. And so when people propose, when two groups are proposing to each other, they're essentially negotiating on chain what that smart contract should be. And so if you think of a creditor and someone who's seeking credit, an investor and an issuer, this is an extremely powerful tool because it brings that entire negotiation process on chain. And because that negotiation process happens on chain, many other properties of a valid and enforceable contract now start to embed themselves in the smart contract itself, rather than outside off chain in the form of paper contracts between organizations. And so that's kind of in a nutshell why this kind of technical architecture facilitates a whole different kind of smart contract paradigm, in that the developers of the smart contract and the users of the smart contract are brought fully on chain together.
Hey guys, sorry to
complete
interrupt for a
system.
second. Miguel Arias, do you mind muting yourself just for a sec? We can hear your background. Thank you. Sorry, go ahead.
Yeah, no worries. And so that's the basic architecture. And so how that actually works, and I'll show you a quick video to show you how tokenization of actual real world contracts works in PairWyse. If I go down here, I'll just zoom in here. If you look at any real world contract, look at any term or condition, say a swap contract. We've looked at so many contracts and documents that what we found was there was a clear pattern when you break down a contract clause by clause, and that at the most granular level, a contract clause typically has a signatory, someone who is authorized to do something or is obligated to do something. It will typically have a condition. They could be simple, they could be complex conditions, but they're conditions, basically a bunch of and or statements. And there is a proposed transaction or a pending transaction. And we saw this pattern over and over again, and we basically modeled PairWyse under this type of patterns. And there's probably many other patterns that can capture real world contracts. But because of our system, we can capture most financial contracts that would typically happen off chain, we can capture on chain through this tokenization. And the key is that if there is a term in an intended agreement between two parties, such as each LP must deposit a minimum 100,000 DAI after fund placement date, but before fund closing date, all of this can be tokenized in PairWyse DSL code as instructions sent from the Web3 wallet directly to the smart contract for processing with no off-chain intermediation. And the main thing is there's a one-to-one correspondence between the DSL code and the intended agreement. So, and then a one-to-one mapping between the DSL code and blockchain execution at the EVM opcode level. And so this thread is completely captured on chain, both in construction as well as in execution. And with the signatory element, this is really then how we start to manage rights and define who has rights to do what in a given contract. And what I'll show you is example, the expanded example of a paper contract. I mean, years ago, Akiva and I were involved in, potentially, trying to start a crypto fund. And so this particular workshop comes from, that experience of basically an agreement between general partners and limited partners. And in this case, consider like a $1 million DAI fund, and maybe ETH is an investment asset. Maybe there's a portfolio that the GP will invest in, but these are the terms and conditions. And so there's things that the GP must do. There's things that the LP must do, and terms and conditions just to, seed the fund. And then there is certain restrictions also placed on the GP. So here, if you extend this to a DAO, you can kind of think of a DAO now trying to act in the role of a general partner, offer some kind of exposure to, say, a portfolio of digital assets. And that exposure to the LPs is, basically mitigates some of the risk for the LP in terms of their yield and seniority. So, and we'll maybe pass the links, and you can see these in the white paper from our website. So in such agreement, there's typically a lockup period, and that lockup period on chain is probably the most riskiest for any LP, because you don't know what's being done with with the funds, and but at least in the TradeFi world, an LP has a legal agreement saying you will return this principal, and if you don't, the GPs are going to take first loss. So it's really a question of how do you actually take a complex agreement like this, and this is a very simple agreement compared to, say, a bond issue. But one that includes basically lockups, withdrawals, withdrawal restrictions, and then after, say, the fund is matured after, say, a period of a year, what are the allocations? What are the GP's fees, the carries? All these things need to be captured in a smart contract. Now, to do this, just a one-off bespoke smart contract like this, in smart contract form, if you just code it in Solidity, you'd easily be dealing with, 1,000, 2,000 lines of code. But if you were to do it in PairWyse, and I'll just show you the video of that tokenization. Oops, one sec. Go back to here.
Hey guys, we're just a little over time. Just maybe after the video we can cap it. Thanks.
Yeah, sure. Yeah. So yeah, let me cap it over here by basically showing you this tokenization video here. So this is that same agreement being tokenized, basically term by term. And so it's basically going to deploy an investment agreement, and now it's going to layer the bylaws of that agreement. And what it's layering here is basically term by term, going to agreement 51, agreement 52, term number 52, adding term number 53. And it is probably about 10x less code you would do with PairWyse than you would do with if you were to do it in Solidity. Now it's one thing to tokenize an agreement, but what's most important for any creditor is the ability to enforce their rights in that agreement. Now, if they can't enforce that agreement in court, they're going to want to make sure that that smart contract gives them recourse. Now, you can use PairWyse to easily create any kind of instrument you want, but really, what you want to do is create an agreement where two parties have recourse against each other, in terms of being able to take an agreement and not just place it in a separate smart contract, but take the terms and conditions and place it on each other's contracts. So if this is one DAO is an issuer and this one DAO is a creditor, PairWyse allows them to negotiate an agreement purely on chain, optimize it, through the proposal process until they're able to create terms and conditions that span not just an agreement between them, but their own treasuries. So some of the smart contract terms and conditions are placed on the issuer's treasury, and some of them are placed on the investor's treasury. And so the agreement isn't necessarily resides on a smart contract; it resides at the bylaw layer across multiple contracts in coordination. And all this is done on chain. And probably the most one of the most important features, let me just go back to the white paper here and I'll end it off here, or the zero cap report. It's really, how is on-chain effective? I encourage everybody to kind of read this. Interesting. But the issue comes to this is if how is to offer a term deposit that says, I'm going to take your money, and then at another period in time, I'm going to promise to give it back. And while I'm holding on to it, I'm going to invest it. I'm going to do something with it. Sometimes I might not have it. Sometimes I will, but I promise to give it to you back. How does that happen on chain? Right now, it only happens on chains through over collateralization. But with PairWyse, we can provide much stronger guarantees of recourse. And so if you read in the latest research report, there's examples of economic recourse. So if the DAO doesn't pay back or pay up its royalties as expected, well, then the obvious thing is then the LP can be given the right to convert at least part of their creditor rights into tokens or generate tokens for escrow. And so this is a way of kind of an LP being given the right to place pressure on a DAO, especially on its token price, if it doesn't fulfill its obligations. So this is one way of soft incentivizing a DAO to make sure it pays up its debts if it chooses to take on debt. And then the other recourse is much more stronger. It's operational recourse. And this is particularly critically important for insurance applications and applications of houses, in that any clearinghouse or insurance protocol must maintain a reserve buffer and maintain its creditworthiness, meaning it can't oversubscribe that buffer. It can't run a Ponzi scheme that just funds go out and funds keep coming in. And if that credit buffer is steadily decreasing because of market pressure, then the most senior credit holder need that recourse to basically put a pause on the treasury so that at least the DAO can't give itself dividends by token governance burns, or the DAO can be restricted on transferring assets out of its treasury until it brings its the previously agreed upon standard. All of this can be done on chain, and what PairWyse allows is all more of the things that typically happen off chain to occur on chain, so that DAOs can build Web3 protocols that are the decentralized equivalents of the facilities you see in traditional finance. I guess with that, we can pause there and open it up to any questions.
Has been like
As isolated from the smart contract itself, so the ledger autonomous actual smart contract container, and then at the other end are yield integrations, where once you build it, you can use the PairWyse DSL, and we'll have a growing inventory of integrations into digital assets, into DeFi protocols, into liquidity pools, staking, and we invite the community to contribute this to the code base, because through the DSL, you can do simple things like compound deposit all USDC. And what that does, in one line, it says, take my USDC and throw it into compound pool for USDC. And then this, what can be affected is every DeFi protocol out there can have their own sub-language on PairWyse that allows purely on-chain transactions for one DAO to another DAO. The vision, the ultimate vision that we're looking at, actually it's in the white paper here, is we're looking to build a decentralized marketplace around PairWyse protocol. And we want to be very decentralized. That's why PairWyse is being brought by a consortium of entities. And in the first phase, it's really about DeFi projects, fintechs, integration partners, providing their integrations of their existing protocols into PairWyse. So integrating with the DSL coding language so that users can basically be able to access all DeFi services that are available through on-chain smart contracts. And once we have a critical mass of developers, we invite developers to basically either take their existing ventures, existing protocols, or to create new ones and bring them into a shared product marketplace. And the idea is that we see a large market of customers who you don't necessarily want to code smart contracts. They want to be able to assemble it like Lego blocks. Just like you do, for DevOps architecture or for anything, they want a drag and drop facility where you can basically use money Legos, as we call them, where they're capital modules, data integrations, oracles, asset integrations, and they would go to the PairWyse marketplace to assemble this, and then of course use low code customizations to suit their use cases, and that's really phase 2. And once we have phase 2 running, the idea is to, and actually I'll show it in a better visual form here. This is phase 1, which is to be able to create a marketplace where you can basically do complex integrations with the real world assets. That is our key milestone for phase 2, is to build this level of capabilities where off-chain assets can have on-chain integrations, particularly through trusts that can be evoked in the real world that are governed by token holders. And so the trust can own real world assets. They can be registered assets like any property. Maybe the property is connected to smart systems that provide Oracle data. But this is kind of the vision of what people can put together from a decentralized marketplace of these products. What we then want to do in phase 2 is then expand that into a risk marketplace. So now once you have people building instruments, those instruments are going to need insurance. They're going to need attestation, whether it's audits, whether it's KYC. They may need notary services in order to move it on chain. And this will be what we think is going to be. It's basically going to evolve into a massive staking ecosystem then around PairWyse, where whether they're protocols or whether they're off-chain entities, if they can provide risk underwriting, if they can provide issuance services, remediation services like liquidation, arbitration, or collection, or if they can provide KYC, we can basically enable them to build themselves on PairWyse on-chain and then integrate their risk services into this marketplace. And when that happens, then I think we get to what you're talking about, which is deal making between PairWyse contracts. And the typical deal making, there's a seller like an issuing broker or a fund sponsor who is a buyer, and the fund wants to drop liquidity into promising issues. And this can happen in a very decentralized way through decentralized over-the-counter marketplaces fully on-chain. And with integration into real world assets, they can actually touch real retail users who might use these products as part of a larger institution's offering. But their dealings, their interactions with these products are registered on-chain. So this is kind of like just giving you the kind of full roadmap. Hopefully that answers your question.
Yeah, no, that was amazing. Thank you so much. I'll read the paper for sure.
Awesome.
Awesome. So I think we're gonna cap it off there for questions. If you do have any questions, you can definitely we'll drop socials and links for PairWyse in our Meetup group. But I just wanted to say, if there's anything else you want to say, PairWyse, just very quickly.
Yeah, we're extending an invitation to anyone, especially developers who are interested and see promise in this protocol. Basically, developers, any developer who wishes to contribute to the PairWyse protocol would be an eventual vendor in the decentralized marketplace. So by contributing to this open source project, we can find points of collaboration that will, really support your ventures and entrepreneurship in Web3.
Awesome. Thank you so much. So yeah, I just wanted to say thank you for everyone for joining the Meetup today. And thank you to all of our speakers for joining, to give everyone who has been here or just even like a wider audience, just insights into today. We will be posting the recording on the Meetup group. So keep a lookout for that. Are there any 2-minute quick community announcements anyone wants to do? Landon, I see you here. All right, perfect. So thank you so much for everyone. And on our next Meetup is going to be in real life in Toronto at 1:11 next month. So just stay tuned for more information, and we're excited to have you guys all there. Thanks for joining.
Thanks a lot.